Hi, good evening, and welcome to UTI's webinar, Market Insight, giving you an overview of the fixed income markets. So I will take you through a series of charts which will broadly give you an indication of where the key macro trends and market numbers are. And with this presentation, maybe once we have completed the entire presentation, we can take questions afterwards. So to begin with, a look at some of the key factors which are driving our markets. Like we mentioned earlier, global inflation is expected to moderate in the current calendar year 2023. We've already seen some signs of that, with the peak rates more or less being visible in the months of September and October of 2022. Since then, there has been a gradual decline as far as inflation rates are concerned, both in the developed markets as well as in India. And the key driver for that essentially has been that the base effects, which largely rose because of the Ukraine war, have started now dropping out, and they're actually moving in favor of the headline inflation coming down. We've also seen a fair amount of supply chains normalizing. In fact, China, which was under a severe lockdown for last 2 consecutive years, has started opening up dramatically, and hopefully this will further normalize supply chains. Finally, we've seen wages which have started reacting to rising unemployment rates, and hence that is also going to some extent, impact consumption going forward. As far as central banks are concerned, they're yet to reach their terminal policy rates. They continue to sound somewhat hawkish, and we believe that a weaker USD outlook combined with incremental rate hikes from developed central banks being somewhat muted can hopefully keep emerging market yields supported. The timing and quantum of rate cuts is still uncertain, while there are expectations ranging from late 2023 to maybe early 2024. I think given the set of variables which are still impacting central bank thinking, both timing and quantum in our view continues to remain uncertain, and we will see how this plays out for the rest of the year. As far as RBI is concerned, clearly expectations which sort of markets had prior to the February policy of a change of stance, leading into some extent of maybe even rate cuts by RBI at the fag end of this calendar year, seem to have been now ruled out for the time being. So let's look at the global trends in terms of the monetary policy action. Again, a month where there's not been any remarkable change as far as the rate trajectory is concerned, but clearly, the trend line seems to be upward sloping with a few more rate hikes expected, particularly from the US, UK, Eurozone, and clearly now expectations of rate hikes from the Indian Central Bank as well. On the inflation front, the inflation continues to be, elevated and nowhere close to the targets which central banks have placed for themselves. In India, there was a bit of a negative surprise when the inflation actually came well above our own uh, expectations, and it looks like we may actually end up with inflation sort of being a major concern going forward. So yeah, I'm just yeah presenting the presentation. Yeah, so maybe you can take a look at the policy rates which are present across major economies. So this is actually the trend as far as inflation is concerned. Moving on to how the 10-year sovereign yields have moved across different economies. Again, you would note that for the month of February, again, there has been a increase after a lull which we noticed in January. We began the calendar year and the month of January, particularly with some degree of moderation as far as benchmark yields are concerned. This was largely in the backdrop of an expectation that maybe inflation will decline much sharper, and the central banks may actually not go to the extent that they had initially indicated as far as the terminal policy rates was concerned. This expectation has actually not played out, and we've actually landed up with some of those expectations being rolled back, wherein February actually saw more or less a bounce back as far as some of these benchmark yields are concerned. So across the board, we've seen anything between a couple of basis point to as high as 63 basis point in terms of the 1 month change in the benchmark yields. And it's quite likely that one could continue to see, sort of the disappointments as far as inflation prints are concerned, and the hawkish statements from central banks continue to keep the benchmark yields at the upper end of the band that we've seen in this chart. Moving on, if you looked at global activity index, again, we've seen the PMIs reflecting both manufacturing as well as services sector declining. And this is again a reflection of maybe some degree of consumption contraction. It's expected that the rate hikes which have been undertaken and clearly front loaded across major markets will start impacting the consumption demand going forward. And that also does, to some extent, indicate that you could see a overall slowdown both in global economic growth as well as for certain specific developed markets. Financial conditions actually continue to remain fairly tight, and this is evident both in terms of the Bloomberg's financial condition index, which, as you can see, remains either at zero to marginally positive levels. And if you look at the federal funds target rate, clearly this is one of the highest that we've seen in almost over a decade, and does signify tightening financial conditions. When you look at some of the drivers which you talked about earlier for inflation coming down, clearly commodities have influenced to some extent. We've seen a broad decline as far as the commodity index is concerned, as well as the food index. This hopefully should continue to at least keep the declining trend as far as in global inflation is concerned, and is also a big positive for Indian macro outlook. Finally, looking at the rupee, for the month gone by, clearly we've seen a marginal depreciation, which is, if you look at the orange bars across this, it's been more or less very similar. We've seen the US dollar actually strengthen in the month of February, and this has led to some degree of depreciation across most of the global currencies. However, when you look at the emerging markets within this universe, you would know that on a year-to-date basis, India has actually been a bit of an underperformer. Rupee has clearly depreciated a lot more than many other emerging markets, and that I think is also a reflection of maybe some degree of weakening external trade. Coming now to India specific trend lines, as far as GDP projection are concerned, clearly we are looking at the sequential quarterly GDP numbers declining. This again does indicate that some of those front-loaded rate hikes that we have undertaken by RBI are going to impact global growth going forward. Now, some of the economic growth decline that we are expecting in India is also driven by weaker exports. That's because global activity, global economic growth is also likely to be weak, because the central banks across the world have been more or less following the same path of hiking rates, and in their attempt to both slow down their respective economies and try and address inflationary fears. When you look at inflation in India, clearly we are in a slightly better environment. We've actually seen inflation come to the corridor that RBI targets for itself, which is 2 to 6%. The current estimates for FY24 CPI inflation are around 5.4. Now that does give an investors a real policy rate spread from where we are at 6.5 repo rate. Clearly, there is a good 110 odd basis point of real policy rate spread. And this has been clearly influenced by both the broader WPI, which is like we've shown earlier, been influenced greatly by the global commodity prices declining along with the food prices, which has been beneficial for Indians' WPI, particularly energy prices, which have actually been pretty much range bound. And as long as they continue to hover around $85 to a barrel, I think that can be some bit of positive, both from a current account deficit perspective, as well as from the broader inflation trajectory for India. But clearly, RBI estimates are averaging a lower inflation for FI for 24 versus the current FI 23. But what you would actually note, which is shown here by the orange bars on the left-hand side chart, is that on a quarter-on-quarter basis, you actually see an upward sloping curve as far as headline CPI is concerned. And this is possibly one of the reasons why, RBI has chosen to not change its stance to, maintain a status quo and also be a bit cautious in terms of their outlook. And hence, there is a possibility that the RBI may actually stay on a pause for much longer than what the markets were earlier anticipating. One notable feature, clearly, as far as inflation is concerned, is the month-on-month, change, which effectively measures the momentum. And this, as you would note, remains, well below the average that we've seen. This is a good indication, which means the sort of inflationary impulses are somewhat weak, and hopefully should continue to drive, the broader inflation trajectory towards a declining trend. We will need to wait and watch because there are certain concerns which have erupted very recently, particularly when it comes to, China opening up and maybe stimulating its economy, combined with the El Nino, the sort of unseasonal high temperature weather patterns, which can at times influence the monsoons and hence eventually lead to some degree of concern as far as the food prices are concerned, particularly cereals in India. So we need to wait and watch on how this really plays out. So till then, I suppose the only comfort we can drive as far as inflation is concerned is the fact that it's at least within the RBI's corridor and is not really showing any signs of any sort of upward sharp spikes or being well above the 6% on average basis. Looking at some of the other financial market parameters, particularly on credit growth, it remains fairly strong. It seems to have marginally declined from the peak that we achieved sometime late November, early December. But again, one expects it to sort of pick up again since the Jan to March quarter is again a fairly busy credit season. And a large part of this, is driven by a very strong surge in both the household borrowings combined with a fair amount of corporate borrowing, which was largely maybe done offshore, coming onshore to the domestic banking sector. So credit growth remains fairly strong. However, deposit growth is fairly weak, which is clearly putting some pressure as far as banks' cost of funding is concerned. And to mobilize additional deposits, they have also passed on some of these rate hikes in the form of attractive deposit rates. This graph again actually shows you the 5-year swap minus repo. And if you really looked at the spread, clearly it's kind of started inverting. And this does to some extent indicate to the markets that one can expect some degree of easing from the central banks. Another indication that we now are close to the peak or the sort of end of this rate hiking cycle. In the past, this has actually been a fairly good indicator as far as the market peaks are concerned. When we look at the shape of the Indian yield curve, it continues to flatten, and particularly after the February rate hike, a change of stance, it flattened even further. with the short end reacting the most. So we saw entire 3 month to 3 year segment move up on an average by about 35 basis point, and at the long end it's largely been more or less flat. So even the 10-year benchmark sort of just moved up by barely 9 basis point over the month. But over the full financial year, in spite of over 300 basis point of rate hikes by RBI, we've actually seen the 10-year benchmark move up by just about 60 odd basis point. In fact, if you look at the yields across different maturity buckets as well as different uh, asset classes, you would know that they have broadly hardened, particularly at the short end. So the T-bill rates, 1 year right up to the 3, 5, 10-year GSEC rates have clearly moved up from where we were just about a month ago. And in the corporate bond side, actually, you've not seen as big a reaction. In fact, when you look at some of the levels that we've witnessed in February, they've actually been fairly flat to marginally higher than where we were January. And I think this is also got to do with some degree of limited supply. But we believe that eventually, the supply will increase for the corporate bonds, and some of this, sort of flat to very insignificant move as far as the yields are concerned presently will also give way to slightly higher spreads. So we will wait and watch for that. I think one of the trends as far as SDLs, the bonds issued by the state governments is concerned, clearly has to do with a fairly large undershoot compared to the calendar or the announced quantum of borrowings. We've actually seen this particularly in FY22, and this has only got accentuated for the first 9 month period of FY23 as well. So as against the announced calendar, both for 9 month period and the last quarter of FY22, and when you compare that with the 9 month period for FY23 as well, it's actually been just about two-thirds of what has been announced. So we've actually been running a rate of barely 70% of what's been announced. And this is possibly one of the reasons why the curve remains fairly flat, because there is a fairly strong demand coming in for SDLs compared to maybe even the corporate bonds, given the both absolute nominal levels as well as relative spreads over sovereign bonds. In terms of the external trade account, we've seen thankfully some degree of moderation taking place as far as the trade balance is concerned. We've kind of more or less come back to the same levels that we'd seen for the same period and the same month last year. But what is still worrying is that on a financial year to date basis, which is effectively April to Jan period, we clearly are almost 30-35% higher in terms of our trade balance, running a negative trade balance versus where we were over the last year. There are expectations that Jan to March period typically does see a strong surge of exports, and one could maybe see some limited increase as far as the negative trade balance is concerned for this quarter. But still, even with the kind of number that we may likely end up with for this quarter, the financial year total aggregate trade balance will remain a much higher number than what we've seen over the previous, financial year. So this is clearly one of the drivers which I mentioned earlier, which continues to remain an overhang as far as the rupee outlook is concerned. Coming to the liquidity in the system, clearly we have seen sort of a very remarkable change as far as the liquidity in the system is concerned, and this has been now running for over 6 months. Apologize for that. We seem to have jumped the slides. So coming to liquidity, I mean, it's now been almost 6 odd months that we've been seeing liquidity sort of moderating close to neutral, with some periods and bouts of negative systemic liquidity as well. And this broadly uh, is consistent with the stance and the view taken by the central bank that they are normalizing policy rates, and hence for the repo rate to be the effective policy rate, they have to keep liquidity in somewhat of tighter conditions than in the past. So while we are not expecting a sustained negative print for system liquidity, which means we don't expect the system to be on a much longer term repo mode, but we don't expect a very large reverse repo surplus either, as far as the as far as the current monetary policy and the stance of RBI is concerned. The spreads, when you look at the AAA, PSU benchmark bonds versus repo, and even the 1 year, CD versus the repo, they are more or less coming very close to the longer term averages, which means, I guess, they're no longer cheap, or from a perspective of an investor, you actually do have significant value that one can look at when you were to choose to invest. I think whenever this number has gone below the brown line, which you see over here, you would note that the markets look somewhat expensive. So they clearly were, meaningfully cheap when this number was significantly higher than the average. They have somewhat sort of achieved near their longer term averages, but still offer value for investors who are looking at, a typical spread of 140 odd basis point for a 3 year PSU versus the overnight rate. And for a 1 year CD, close to about 100 odd basis point of spread over the overnight rate. So summarizing some of the key takeaways, as we see it for the markets, clearly, the unexpected policy status quo was a bit of a surprise for the markets. However, the rate hike was in line with the market consensus. I think in the backdrop of what we've seen, both in terms of global economic uncertainty as well as the central banks still sort of displaying uh, their open approach to the policy rates. We've also seen sticky core inflation with an upward sloping CPI inflation trajectory for India in particular. I think it was appropriate for RBI to exercise caution while focusing on incoming data. This, I think, will more or less be the stance of RBI going forward into the next policy event, unless the data really surprises on the downside. We do not expect RBI to sort of change their current cautious stance. We think clearly RBI is waiting for a decisive moderation in inflation, and not just the headline. They have clearly been amplifying their concern on the core inflation, and hence RBI will wait for not just 1 or 2 data points, but maybe a more definitive trend as far as inflation trajectory is concerned before they would want to change their current removal of accommodative policy stance. At the same time, they have stated that they are evaluating effects of past rate hikes. And this is also reflected in both reducing the last size of the rate hike, which was just 25 basis point, and also the way the markets currently are expecting the rate hike also to be not more than 25 basis point. Finally, when you look at the broader economy, clearly there are expectations of slowdown, particularly driven by the fact that we have front loaded pretty aggressive rate hikes across the world, and the signs of inflation definitely are a big positive. As far as inflation continues to moderate, I think the rate outlook will continue to indicate that we are reaching the peak. But if the data was to disappoint in terms of higher inflation prints going forward, then I think some of the expectations from how high the central banks can go can also change. As of now, I think the markets expect incremental rate hikes to be smaller in size and definitely fewer in number. So the range is between 1 to 2 more rate hikes from here, and no rate hike being more than 25 odd basis point. Similarly, when it comes to India, I think the expectations are on the similar lines. I think RBI will also continue with what they stated after the February policy, that they're looking at a reduced size of rate hikes and focus more on the incoming data. For India, I think the supply of bonds, the new financial year 24 is an important element to watch out for. Uh, we think the rates can remain somewhat range bound with a continued flat yield curve in India. Uh, I guess when you look at sort of some degree of repricing that can take place, it's going to be driven a little bit by how the new auction calendar is announced, and obviously how the markets adjust or accept the new supply in the coming financial year. Finally, when you look at the global conditions, I guess they are turning fairly benign. In fact, in India in particular, we are seeing a reasonable level of real yields, and I think that sort of should make certain product categories a lot more attractive. And we'll touch upon that a little later in the presentation. We believe investors with 6 to 12 months of investment horizon could consider continuing their allocation for low duration money market kind of products and strategies. And investors who actually have a 3 year plus investment horizon should consider allocation to a combination of roll down or passive strategies with a marginal allocation to even the actively managed short to medium duration product categories. Clearly, like everyone believes that we are at the fag end of this rate hike cycle. At some point in time, the central banks will pivot, and you could see rate cuts going forward, and that clearly can benefit the slightly longer duration products, particularly in the short to medium term, which is running durations between 1 to 4 years. I think these products can actually help capture some of that upside from likely rate hikes going forward. So those are some of the recommendations that we had. And coming to a specific point that we want to make on why we want you to look at fixed income funds. Clearly, the real returns from fixed income funds have become a lot more attractive and supportive of allocation in fixed income funds. And over the last 3 years, we've actually seen real yields, which is effectively what you would get from a 1 year bond or a debt security versus the average inflation for that year being negative, deep negative. In fact, that clearly was a big disincentive to allocate money in fixed income products. But in 2023, clearly we are seeing a significant increase in this real yields, which has now turned a meaningful positive to 20 odd basis point. When you look at the 1 year yield, that is available from a typical 1 year PSU bank CD versus the current inflation expectations, which are close to about 5.4% for CY 2023. So to summarize, with this repricing that we've seen in the yield curve, we actually are getting real income from fixed income funds. Secondly, when you look at relative valuation of asset class versus equity, clearly, the difference between the Nifty 50 yield and the 10-year GSEC yield has turned meaningfully negative. And the longer term yield difference has generally ranged around 100 basis point or 1 percentage points in favor of G6. This currently is almost 200 basis point, which is largely a function of the 10-year benchmark yield moving up significantly over where it was a year or 2 years ago. And at the same time, in terms of the likely earnings growth that the equity markets are expecting, there's not been any remarkable increase over there, and hence you actually are seeing sort of the earnings yield on the Nifty 50 being somewhat flat to moderating. So on a relative sense, debt clearly is looking more attractive, and that's also one of the reasons why both combined with the real yield that you're getting from fixed income funds, it makes ample sense for investors to start allocating money to fixed income funds. Coming finally to why fixed income asset class actually benefits an investor's portfolio. As this chart shows, one of the big benefits of staying invested in, a short duration fund or a long duration fund, no matter what investment period you look at, whether it's 1, 5, or 10, you would note that the volatility, which can be seen in the bars over here, the minimum and the maximum returns that you can get from an asset class is much smaller or lower than that you would see for an equity. Clearly, the long duration funds are more volatile than short term income funds, and cash, as can be seen in the form of a liquid fund or a investment, is one of the lowest. But as you increase your investment horizon to 5 years and 10 years, not only does the volatility decline, but your average return, over that sort of a holding period increases. And this is one of the reasons why, you could possibly look at slightly longer duration, sort of longer investment horizons, not necessarily longer duration products. But if you were to invest in a short duration or a short-term income fund over a 5-year rolling period and continue to sort of hold on to it, the minimum return that you would have got would have beaten cash because it would have been close to 6.56, and the highest return would have been 9.5. But the average that you would have seen over last almost 7, 8 years that uh, this chart covers the measurement period, your average return would have been about 8.34%, which is shown in the middle part of this chart here. Obviously, as you go longer into a 10-year horizon, your volatility or the min-max range that you would see from a short duration fund or a long duration fund reduces even further, and the average sort of still kind of targets or achieves close to about 8% of return over here. So I think these are what parameters to consider when you look at fixed income funds within your overall asset allocation. And we do recommend, not only from a timing perspective, given the fact that real yields are positive on a relative basis, debt looks attractive to where it has been, in the past. But finally, when you do have a longer investment horizon, it makes sense to, invest and stay invested in some of the fixed income funds because they've been able to beat inflation and deliver a decent set of returns for investors. So with that, maybe I will end the presentation and some of the sort of comments and views we had, both in terms of the broader macro, interest rates, and also specific products. So with that, I'll pause here and hand it over to the moderator to start the question and answer session.
Thanks, Amandeep, for this comprehensive explanation and sharing your insights on the fixed income markets. At this time, I would request our viewers to keep posting their questions on the link provided to you. However, we'll queue up the questions and start taking it. To begin with, bond yields are high now. FD interest rates are also increasing. How do you see yields moving on from here in the near to mid-term? And also, a second question on this, sir. If there is a pause in the current rate hike cycle, what strategy would you advise investors to adopt?
Sure. Thank you, Sonal. I think both interesting questions. Clearly, from our perspective, we're not expecting any immediate pivot as far as RBI is concerned. We think a baseline view would be that they may be likely hike the rates one more time. This is clearly contingent on the fact that Fed continues to be fairly hawkish, and they continue to signal that they are in no mood to pause anytime soon either. So, to an extent, as long as the Federal Reserve, continues its hiking actions and then maybe stays high for longer, we believe it would be appropriate for RBI as well to, maybe affect one more rate hike and then stay on an extended pause. That to some extent would ensure, some degree of financial market as well as currency stability. So at this juncture, clearly it makes ample sense for investors to not try and wait for that, final sort of policy rate action from the central bank. Like I mentioned, the markets are already pricing in another rate hike as far as RBI is concerned when you look at the swap curve. So it does not, benefit any investor from waiting out for the next policy meeting. So investors can actually continue to, focus on investing at the current levels. We've seen, the 10-year benchmark and the 5-year benchmark, treasury yields sort of move within 10 odd basis point on either side. And that sort of in a way does present, the current set of views. The benefit you get actually in the current month clearly is that for an investor who comes in with a sort of 3-year, a little over 3-year investment horizon, benefits from an additional indexation benefit, when he comes in a mutual fund product. So clearly at the present juncture, like I mentioned earlier, you can look at two strategies. One which tries to, take the benefit of current yield and gives you a decent carry, which in my view will definitely outperform a bank deposit. While you're right, both the rates have gone up, but even if the bank rate deposits to go up, marginally by another 25, 50 basis point, I believe, the some of the mutual fund products that we are offering in the form of fixed maturity plans, the roll down strategies, the current attractive YTM that you're getting into, or even the target date, index funds, where the YTMs are fairly attractive, can be looked at. And on the other side, since at some point in time the cycle will also turn, like we've seen over the last, many decades, uh, to benefit from any such turn or pivot, as it's popularly called today, you can have some allocation in short-term income fund, maybe even the corporate bond fund, which can take its modified duration up to 5 years. And for those who are a little bit more, aggressive in their risk appetite, can look at the 10-year constant maturity GSEC fund or a dynamic bond fund.
Sure, thanks for the answer. Moving on to the next question. Despite series of rate hikes, the inflation number is not under the target band. Also, globally, the macro factors are not very favorable. Do you think MPC will restrict the policy rate at 6.5%, or do you see any further rate hikes? Considering that Fed also recently mentioned that they're not going to stop at this juncture. So, your views on it?
Sure. I think our baseline view was that RBI will stay on an extended pause, maybe at around 6.5%. We were not expecting any rate cuts. That I think clearly was ruled out, and we stated it prior to the Fed policy as well as in the post policy call. I remember, we did state that out, that we're not so sure whether RBI will effect another rate hike, but clearly any possibility or expectation of rate cuts, which is what the markets, were believing, are ruled out. So I think at the current juncture, you're right. I mean, inflation did disappoint. The Jan print was much higher than the markets expected, but that's, I would say to some extent, the very nature of our inflation, sort of index, where food does have a fairly large swing factor, and the surprise element clearly came in from food, just the way it sort of it declined over the previous month. We believe as we progress going forward, unless there are some concerns or anomalies on monsoons, we think this again will start declining. We've already seen some prices as far as say onions, etc. concerned are declining. Thankfully, the government is intervening by offering wheat from its buffer stocks, which hopefully should again cool down the prices of cereals. And this, to some extent, can have a moderating effect as far as headline inflation is concerned. I think broadly the headline inflation is as per RBI's expectations, and this is what even the market expects. The biggest driver of inflation coming down, like I mentioned earlier, is more on the backdrop of the GDP growth actually declining, right? And I think that's really something which we have to see play out. We've seen RBI hike rates barely, 9 months for a 9-month period. So the impact of those rate hikes have yet to be seen on a in a full-fledged manner, which we will only start witnessing now. And some of that, in our view, will also be beneficial as far as inflation is concerned. So that's something to wait for. If inflation continues to disappoint, and does not trend closer to 5%, which is what RBI has been indicating in its forecast, then I agree. Then there will be no choice but for RBI to maybe affect another rate hike and maybe delay any reversal going forward. But if they actually start seeing impact of the previous rate hikes into a growth slowdown, definitely we've seen consumption slow down a bit. Then you could start seeing its impact and inflation coming down to maybe closer to 5 or even sub 5, which I think will give comfort for RBI to then maybe take a pause and start focusing more on becoming a bit more accommodative in its monetary policy stance.
Sure. So the next question here is, given the yield curve is flat on the longer side, do you think investing in long-dated papers is beneficial at this juncture, considering risk-reward scenario? And a follow-up question on here is, if investors should come into long-dated funds, then what should be the mode they should adopt for investing? Should it be SIP mode or lump sum?
So I think, like I did mention this earlier in my comments, that the curve is very flat. So you're not really being incentivized to add duration at the present juncture. The appropriate time to maybe go very long on duration would possibly be when there are some clearer signs of a policy pause from RBI, because that's when the next move could likely be rate cuts, and this is what the markets will focus on. Till then, we believe the sweet spot for investors still remains in the 3 to 5 year segment, because that's where you're getting a semi-annual yield between 740 to 744 from a 5 year treasury, and maybe from an SDL even higher than that. And that, I think, is pretty attractive at the present juncture. If even if you were to see some dovishness coming in from RBI, clearly there are expectations that the curve could steepen a bit and there could be a bull steepening, so which will also give you some bit of upside by staying invested in this sort of maturity bucket. And that's really one of the reasons why we continue to recommend short-term income funds, corporate bond funds, going up to maybe a medium-term fund as a pure buy and hold. For investors who have an appetite for long term, I do agree that the current yields are flat and maybe not looking as attractive. But if you really do have a long term investment horizon of 10 years, then the best strategy would be to start doing an SIP. So even if these yields were to move up a little bit higher because of additional supply in the coming financial year, you can actually capture that in. So rather than waiting for that perfect level or the perfect sort of yield on a long dated GSEC, it's better to sort of apportion your money, and your point of entry that way does look a lot better. So these are like two sort of very different strategies which are clearly geared towards investors who have a defined allocation for fixed income, and those who want low volatility and predictable returns, versus those who want slightly higher returns over a longer period of time. Because, like I displayed in one of the slides earlier, longer investment horizons does benefit fixed income investors as well, but can withstand the intermediate volatility that one may see.
Sure. So on the inflation only, we have a viewer who is again asking a question on, since CPI in a country is consolidating at 5-ish levels, why RBI has to look at US interest rates and then increase repo? Uh, your views?
Yeah. So, I think one can argue that monetary policies across the world are somewhat decoupled, because they do focus more on the local factors. But at another level, you cannot afford to ignore both the rates as well as the direction of rates when it comes to US, particularly because, as you're aware, the global reserve currency still remains US dollar. So in one way or the other, the US dollar does react to what kind of a monetary policy the Federal Reserve follows. So there are certain linkages which one has to be, aware of and one has to acknowledge. And that's one of the reasons why, central banks across the world continue to keep looking at the Fed in terms of devising their own monetary policy. Because even if you were sort of agnostic to what, the US Fed does, but a strong dollar and a weaker, home currency means it does, you know, sort of bleed into inflationary pressures, right? Because as you're aware, India is a net importer, and the large trade imbalance that we talked about, the negative trade balance, clearly indicates that we import a lot more than what we export. So, we are now one of the largest importers of energy and many other commodities, and a weak rupee means that that spills over into domestic inflation.
Sure. A question here is most treasuries are preferring to invest in a 3 year kind of products rather than taking a duration call or looking at 5 year products, even when the yield curve has gone flat. So, please share your views on the likely thinking behind the investments here when the reinvestment rate risk could be higher after 3 years.
So I think I've already explained the rationale and basis on why, we are recommending the sort of the particular maturity bucket for investors. Now, you may argue that the reinvestment could be higher if you were to stay short and keep rolling over that money, but I think it sort of negates the benefit of staying invested and maybe not getting necessarily that higher rate that you've been expecting, because I think it's going to be quite a difficult effort in the current cycle for investors to try and perfect that timing of catching the peak of interest rates. Maybe the markets may move well ahead, and some of those expected peak that one is waiting for may not even take place, or may be so abrupt and quick that you may miss out. So I think rather than focusing on that perfect level to increase duration, or to maybe look at a slightly longer category product, it's better to see where you are presently, whether it's offering you a value, and maybe start allocating your money. Maybe you could even stagger your investments if you still believe that we still are maybe 25 or 50 basis point further away from here. I mean, do realize that with the, like I mentioned, we moved overnight rates from 3.35 to 6.5 today, right? That's a meaningful reversal as far as policy rates are concerned. Clearly, incrementally, whether it's in India or in the US, you're not looking at even anywhere close to that extent of hardening of rates from here. So I guess like we've been saying over the past few webinars as well, we are in some ways close to this faggot of the rate hiking cycle, and the time to start allocating money would be now rather than waiting it out. Secondly, if you looked at the spread, that you can get from, say, a 1 year over a overnight fund. Similarly, for a 3 year over a 1 year, the spreads are reasonable, particularly in the 1 year over overnight, right? You're getting a spread of almost close to 140 odd basis point, like I mentioned earlier. And over a 3 and a 5 year product, you still are getting a spread between 30 to 45 basis point. So that's really your basis for looking at uh, what kind of attractive entry points you can come into for some of these strategies.
Sure, thank you for the elaborate answer. Moving on to the next question. So many of our viewers are asking for views on the credit risk funds, and also how UTI mutual fund mitigates credit risk for their funds.
Sure. So I think from UTI's perspective, we've been clearly articulating how we manage the entire fixed income funds through our GIMS framework. That GIMS is essentially an acronym for Gate, Investments, and Monitoring and Surveillance. So this, in a way, are the three pillars which are the foundation of how we manage our fixed income funds, whether it's our liquid fund or the more credit oriented strategies like the credit risk fund and medium term fund. Now, as the acronym suggests, GATE essentially, to sort of simplify what it means is, as you're aware, a gate is a barrier which opens and closes and allows entry or exit into your home. The same is very true in terms of the entry or exit from our investment universe. So, GATE refers largely to the research process that we follow. We have a five-member team consisting of four analysts headed by a head of credit research who carry out a fairly detailed appraisal on the likely issuers before they're onboarded or included in our investment universe. So before any new name comes into the investment universe where a fund manager can invest in, it undergoes a fairly rigorous test. There are three parameters which the credit analyst has to present to the investment committee. It refers to internal rating, the tenor for which one can invest, and finally, what kind of an amount that we can take an exposure in. So how is our gate process different from maybe a rating agency or anybody else? Firstly, the tenor and amount matters a lot. So our analysts have to have in this sort of a credit model and a forecast earnings and balance sheet for an entity for the period that they want to recommend an investment. So you will not have our analyst having only a 1 year view on a company and UTI taking a 3 year exposure in that entity. So if you have to take a 3 year exposure, our analyst clearly has to have a 3 year view on the company. He has to build a credit model which factors in a 3 year earnings. Secondly, it's one thing to sort of forecast into the next 2, 3, or 5 years in terms of a company's financials. But what is also critical and important is how is the stress tested through various business cycles. We know that over a 3 year or a 5 year investment period, companies will undergo a lot of changes driven by their own operations as well as what happens in the industry. So the credit analyst actually has to stress test and see, what kind of deterioration one can see in credit metrics and whether it still meets the threshold level for us to, look at such an investment proposal. So that's a very important element because that sort of, in a way, prepares us to understand the strengths of a company and how much of stress can it handle, given the fact that many businesses have cycles. Thirdly, a lot of emphasis is given on qualitative aspects, particularly corporate governance. And this is where a company to qualify to be part of our investment universe has to meet a minimum, corporate governance score before it can even be considered, for a more detailed research process. There is a very elaborate system of looking at various aspects of the management of the promoter group of various other balance sheet parameters, related party disclosures and related party transactions which go into arriving at a corporate governance score. So that again is a very important element of our overall gate process. Then comes investments I. This is where the fund managers essentially have to now run strategies. Again, for each fund, we have very clearly articulated, what the fund can or cannot do. This is provided in, the GEMS framework for the fund as well. So over there, you would note that, we have a very specific investment framework which covers risk management, covers liquidity management, and also includes now the regulatory, provision of a PRC classification for the fund. So all this essentially will define the characteristics and the strategy that a fund will run. Finally, having created an investment universe, having invested or constructed a portfolio, you also have to look at, how do you monitor and review it, right? It's no different from a typical performance appraisal that an employee undergoes, on the job. So this is where we again have a dedicated resource who also utilizes, certain external vendors to provide us with inputs, which can serve as early warning indicators or red flags, which can be triggered to the credit analyst if it's a credit specific event or a company or a industry specific event. And on the side, if it's something related to the market or the portfolio deviations or drift from the mandate, then those clearly, are flagged off to the respective fund managers. And all of these are, clearly sort of documented and reviewed by our head of risk and further presented to our investment committee. So we have a fairly elaborate governance structure when it comes to managing the various elements of fixed income investing. That I hope should give comfort to investors that we do have a fairly robust model and processes in managing our funds.
Uh, Thanks, sir, for this answer. The first part of the question, your views on the credit risk investments into credit risk funds at this juncture.
Yeah. So I guess when you look at the past, given the fact that most of the other fund categories did face a fairly strong MTM impact, credit risk category was an outperformer. But like I had shown in an earlier slide, where the spreads for a double A, corporate bond, whether you look at a 3 or a 5 year segment, are not particularly uh, attractive from a spread perspective to what you would fetch from maybe some of the triple A's or sovereign bonds. We believe that currently they may not be as attractive because the incremental data that you would get from what the YTNs we are running in the credit risk fund versus, let's say, a typical high investment grade product like a short term income or even a banking PSU debt fund, it makes more sense for you to focus on those at the present juncture. We think this repricing will take place. We did see a phase of repricing in 2022 where the YTMs of credit risk funds did increase and they became somewhat attractive. Maybe we will see a similar phase in FY24 once liquidity tightens, once some of these rate hikes are passed on, and you actually have increased corporate bond issuances in the market. Till then, I would recommend the key product categories that we spoke about. Just stay focused on that.
Yeah, thanks. Looking at the paucity of time, we'll take 2 or 3 more questions. Okay, so government has been issuing sovereign green bonds, and so what are your views on this, and how do you plan to include these bonds in your portfolio?
So clearly, sovereign green bonds are a new asset class for fixed income investors, and they are more keenly sought after by funds who have specific, ESG related mandates. These bonds do trade at a slight premium, effectively, a slightly lower yield than a comparable, benchmark security. So I guess, to some extent, from our perspective, we believe that this market is still somewhat shallow. It's in a very early stages, maybe not as liquid as we would want. And we are sort of actively watching this segment. And at an appropriate time, maybe at an appropriate pricing, we may look to enter some of it. But as of now, it's not necessarily high on our priority or preferences when it comes to allocating money in sovereign bonds.
Sure. One more question. So state municipalities have started to come out with the municipal bonds, with Indore being the first city to list one such bond, and also government has made it kind of mandatory for cities to get their credit ratings done under the Amrut or Smart City missions. So how do you see this market for municipal bonds developing, how the liquidity will be in such bonds, and yeah, your views on this?
Sure. I think that's an interesting question. You're right. We do believe that, to add more depth and variety to the fixed income markets, you do need, other class of issuers. And I think municipal bonds are a very big part of more developed markets when it comes to the size and the quantum issuances. There's a lot of corporations, municipalities, or towns actually do issue independently, such bonds. I think in an Indian context, we are at the early stage. I think if this momentum sustains, one can clearly see some size and depth in the market. Uh, what I guess remains challenged in the initial stages clearly is one, there is still a fair degree of opacity or limited information available. Unlike a corporate bond issuer who does comply with a lot of listing related regulations and has a fairly large amount of information available in the public domain to assess the financial conditions and monitor those financial conditions on a quarterly basis. For municipal corporations, it does pose a challenge at present, barring a few who have come into the markets and are rated very highly because of the kind of structure that they have created. It's very difficult to assess and track the financial conditions of some of these entities. So that's really one. The second, I guess, is something which, as an open-ended mutual fund, we all focus on, which is the underlying liquidity of those. At the present juncture, the size and the kind of interest which is shown is not as broad-based as what we would have liked, and hence that makes inherently these bonds somewhat illiquid. So at best, it can maybe, at some point in time, when we feel that the levels are attractive, we could look to add a little bit, a small portion in our overall portfolios. And then, of course, one can see maybe more interest, as the issuances, sizes, and the sort of the number of such issuers increases. And hopefully, they will also bring in some degree of financial discipline in terms of more frequent disclosures, a lot of availability of public information on their cash flows and how these are managed. So I think some of those are factors which hopefully should play out and make this somewhat attractive. In the present juncture, I guess priority still remains in terms of having more liquid assets, and since some of the more liquid SDLs are yielding such attractive yields, we believe that there is maybe more value in some of those. And hopefully, like I said, if liquidity improves, if maybe you get a decent pricing and some bit of credit comfort builds in, then we will look to add a small portion there.
Thanks. One last question for the evening. Since the current tax guidelines which changed for market linked debentures (MLDs), and it has now become little less attractive from taxation perspectives. So, do you think that will lead to some increased inflows into mutual funds, or mutual funds can be a better alternative for investors who had been earlier investing into MLDs? So, over to you.
Right. I would maybe agree to this point that while the taxation amendments to MLDs are beneficial for the other asset classes, not just mutual funds, but clearly mutual funds inherently have always provided certain specific benefits to investors, which continue to now become even more attractive. Like I said, it offers you a range of products to suit your investment horizons, to suit your risk appetite. It offers you unparalleled liquidity, which many of the MLDs, even in the earlier avatar, were not necessarily providing with you. Of course, you do have the benefit, like I mentioned, both of the nominal yields that one looks at when you look across asset classes, which have now repriced, the higher policy rates, making it that much more attractive from a 1, 3, or a 5-year, investment horizon perspective. So, of course, those are benefits which, in the present juncture do outweigh, a plain vanilla MLD. So, maybe some of these assets were looked at only from a taxation perspective, and clearly that's not a good enough, investment rationale. And that's also a very risky investment rationale, because the moment that incentive goes away, you can just imagine what happens to investors who are holding on to chunks of that particular asset class. That's one of the reasons why we believe mutual funds are far superior, because they offer you not just one benefit, there are a combination of benefits, and that sort of should essentially be looked upon when you look at mutual funds. It's not just taxation, it's also the fact that you can match your investment horizon, you can look at what kind of YTM of the portfolio you would be interested or attracted to. You have liquidity which is unparalleled, and of course you get the benefit of capturing interest rate movements in the market, which maybe some of these other assets or instruments do not provide.
Thanks, Amandeep, for this answer. A request to the participants here to please share your feedback through the link provided to you on the screen on the topic covered today and also in the webinar in general. It will help us to do better in our engagements with you. And any closing comments from you, sir?
Uh, I think nothing more to add, but just focus again on your asset allocation. Don't ignore debt. It has clearly the time for debt, in my view, has returned again after maybe 2 odd years of being somewhat not as attractive. And clearly, for somebody who has investment horizon of 3 to 5 years, do look at slightly longer duration products as well. Don't just stay wedded to the very short maturity products.
Thank you. Thank you, participants, for joining in. Looking forward to see you in our next month webinar. Till then, happy investing.
Thank you. Bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.